All right. I think that's about everybody. Good morning. Very welcome. This is the Swedish House of Finance annual conference. The Swedish House of Finance is the finance department of the Stockholm School of Economics, a national data center, and several other functions. Every year, there's one conference this time of year that brings together people from industry, government, academia on some important theme. Last year was fintech, it's been insurance, and so on. This year it's sustainability. That worked out perfectly because the Mr. Financial Systems research grant that's running right now is about sustainability, and so this is a joint effort this year by the Swedish House of Finance, and we have funding from Söderberg Foundations as well as MFS. So sustainability seems like it's an absolutely booming topic in industry. There's so many people who want to invest sustainably, and it's growing really rapidly. And for once, finance, academia is maybe a little bit behind the curve. But I think we're catching up, and there's already been a lot of interesting stuff done. And our keynote speakers today will bring some of that cutting-edge research to bear on everyday life in the financial sector. So we hope there's going to be a great day of dialogue and learning. I promised to mention that there's bathrooms 2 flights up as well as on this floor. And also, if you ever want to ask a question or interrupt the speaker, you can take this up and you just press it. So when it's red, it's on. And then when you're done speaking, you have to press the little button again, and then it's off so that you can talk. I guess that's it. The first keynote is Laura Starks from the University of Texas at Austin.
Good morning. I am very glad to be invited. I thank the organizers for including me in this conference. I'm excited about the next few days. I've been teaching environmental, social, and governance investing since 2011 to undergraduates and MBAs, and it's been so interesting how much this field has changed over the past 7 years, and particularly the renewed interest there's been from investors, both individual and institutional. So what I wanted to talk about today was institutional investors and ESG issues, talk a little bit about the growth of interest in this field, and talk about some of the research that I've done in the area. So the one thing I should caution or explain is that I have some personal views from involvements I've had in this area. So first of all, I'm on the board of CREF Retirement Annuities and TIAA CREF mutual funds. TIAA is a financial services company in the U.S. that started as a retirement fund for college professors, and then it's grown to where it's now over $900 billion in assets under management. Employee Retirement System of Texas, I've been on the Investment Advisory Committee for a large number of years. The Norwegian Government Pension Fund, I've helped in 2013. I was on the Strategy Council to write a report on responsible investing. And then in 2014, I was on an expert panel to look at whether the fund should be used as a tool to combat climate change. And both of those reports that we came out with are available on the web. And then the Investment Company Institute, which is an association that represents mutual funds in general. Because of my role as an independent director on TIAA CREF, I am on their board of governors. So this increasing interest that I've been talking about in ESG issues can be seen with a number of pieces of evidence. First of all, this is the number of news stories that have included green energy, social responsibility, socially responsible investing, sustainability, or environmental, social, and governance. And you can see how the number of news stories has increased quite a bit over the last 20 years or so. Also, if you look at Google search trends, there's been a big increase in, and this was a category that they had, which was environmental, social, and corporate governance on Google. You can also, the principles of responsible investment, signatories has grown quite a bit over the time period, both in terms, on the right-hand side, it shows the number of signatories, and on the left-hand side, it shows the assets under management, and there's close to 80 trillion in assets under management. Okay, so one question is, who is most focused on ESG issues? You probably won't be surprised that Europeans, in terms of looking at regional areas. The next is Canadians. And so this shows the percentage of their total portfolio that factors in ESG principles. If you look at individual investors, there are multiple surveys that show it's millennials and women that are the most interested in ESG issues. So there was a survey of individual investors, and some of the things they also found about their interest in ESG, which was the main reason for the survey. So there were 22,000 investors across 30 countries. But some other things they found was that 78% believe sustainability is more important than it was 5 years ago. 64% have increased allocations to sustainable funds. And the motivation of those investing in green technology funds, 43% said because they wanted to have a positive impact, but 31% said because they thought it would bring outsized returns. And again, these are individual investors. I'm going to come back to some of this later in the talk and talking about institutional investors. And then 75%, this is just an interesting tidbit, 75% regularly buy organic food and invest in sustainable funds. There are also differences in views on ESG between individuals and their financial advisors. Again, I said millennials and women are the main individual asset owners interested in investing according to ESG principles. They found 76% of millennials and 70% of women of all ages were interested. Then MSCI has pointed out that millennials are going to be 1/3 of all adults in the U.S. pretty soon, and that there's going to be this generational wealth transfer from baby boomers to millennials, which again can shift how people are interested in what they're interested in investing in terms of ESG. But the same survey found that 60% of financial advisors are skeptical of ESG. So we have this kind of tension between what the millennials and women say they want and what the financial advisors think they should be invested in. Okay, so this is some research that was looking at the difference in flows into socially responsible funds over time. So it shows up here, this shows net flows to SRI funds, and you can see there's only, and this is quarterly, there were only 2 quarters, and these were domestic equity funds. There are only 2 quarters that had negative flows. All of the rest had positive flows. If you compare this to net flows for just general domestic equity funds, you can see that there are lots of quarters that had negative flows. And if you compare, you can see there's a real difference between when people were pulling money out of domestic equity funds, they were still putting money into the SRI funds. And what we also found in our research was that there was greater growth and more persistence to flows into the SRI funds than into conventional funds, and that the inflows to SRI funds were greater after environmental disasters. Our argument is it makes people more aware. So we found in particular that after the BP oil spill and after the Fukushima disaster, that there were a lot more money was going into SRI funds than going into the regular kind of mutual funds. And this was controlling for the fact that there was a lot of growth in SRI funds versus the other kind of funds. And we also found that the inflows to SRI funds were greater after accounting scandals. We haven't looked yet to see what has happened after certain political events and whether that has, the hearsay is that some political events like the November 2016 election also caused a lot more people to become aware of SRI funds. So why should ESG matter to investors and their portfolio firms? Just some of the main political motivations for ESG investing: a belief that ESG can enhance performance, and again, we're going to spend time today in this conference talking about this. A belief that ESG can reduce risk. Many institutional investors are universal owners. They own a lot of companies worldwide, and so they may desire to mitigate the cost of externalities, because if there's one company that is harming the environment, for example, it may be harming other companies in their portfolio. So they want to mitigate the cost of these externalities. There's also motivation to avoid compromising value through investing in a company that the investor considers to have problematic products or problematic behavior. And then being responsive to investors, participants, or other stakeholders is another reason for having ESG investing. So then we have theories. Those were motivations on why investors would be interested. We also have theories on why ESG or corporate social responsibility should matter for firm value. So the arguments have been made that firms with higher ESG or CSR profiles can attract more customers. Customers are interested in companies that are socially responsible and that are good for the environment. It can lead to higher employee morale and productivity. There was a survey from McKinsey some years ago that said their main interest, this was a survey of CEOs, and it said their main interest in corporate social responsibility was because their employees were pushing them. It said customers were second, but the employees were the ones that were pushing them the most. The argument is that employees want to work for firms that are doing better for social good. There's the argument that it can attract shareholders who want to delegate their philanthropy to better inform corporate managers. So the argument is the shareholders want the company to be doing good, and they're willing to give up some of their return for the company to be doing well. Another argument is that firms with higher ESG, CSR profiles are more likely to make long-term decisions. And so I want to spend a few minutes talking about some research on the relationship between companies with longer-term decisions, investors with longer-term horizons, and ESG profiles. So the idea is that the firms with higher ESG profiles would be combating this problem of short-termism. And this is a problem that's been talked about for a long time. In 1935, John Maynard Keynes stated, professional investors and speculators, are concerned not with what an investment is really worth to a man who buys it for keeps, but with what the market will value it at under the influence of mass psychology 3 months or a year hence. Marty Lipton who is an attorney in the U.S. One of the things he's very famous for is having developed the idea of poison pills. And he stated that it was up to directors whether the long-term interests of the nation's corporate system and economy should be jeopardized in order to benefit speculators interested not in the vitality and continued existence of the business enterprises in which they have bought shares, but only in a quick profit on the sale of those shares. And then another example is the K Review in the UK, which concluded that short-termism is a problem in UK equity markets and that the principal causes are the decline of trust and the misalignment of incentives throughout the equity investment chain. So short-termism has been claimed to be a problem. And the idea is that by having a higher ESG profile, companies that follow these principles would also be looking more at the long term. So the hypothesis we looked at is whether long-term investors are more interested in ESG firms, and I should say in higher ESG profile firms. And we tested this in 3 different ways. We looked at the institutional investor at their portfolio level and examined the relationship between the different institutional investors' horizons, their investment horizons, and the ESG profiles of their portfolios. Our hypothesis is that the investors with longer horizons would have a portfolio that has a higher ESG profile. We also look at the firm level, where we examine the relationship between firms' ESG scores and the investment horizons of their investors. So in the first test, we're looking at the portfolio of the institutional investors. In the second test, we're looking at the individual firms and who are their owners. And then in the third test, we're looking at a big change, kind of a shock to a company's ESG profile by whether they were included or excluded from the Footsy for Good index and how their owners changed their ownership in the firm after that. So the first one, and this to me is just kind of the heart of our whole story. What we've shown here is this is the value-weighted ESG score on the vertical axis. And so it's the average for the portfolio holdings. And then here we've divided the mutual funds in this case into 5 different buckets according to their investment horizon. So we're looking at how long a time period do they typically hold their portfolios. And we have, we have the long horizon funds here and then the short horizon funds. And as you can see, the long horizon funds have the highest ESG scores, and it just goes down steadily to the short horizon funds, which again, just to me, backs up our hypothesis. We did the same thing here for what we call 13F institutions in the United States. Institutions that hold more than $100 million of equities have to report quarterly on their holdings. And so we're able to get information on their holdings from that. And these institutions include asset managers, pension funds, mutual funds, insurance companies, and banks. And again, we find the same thing. Those with the longer horizon have higher ESG scores compared to those with the shortest horizon. So we also looked at this in regressions. Controlling for a number of other characteristics that could affect the portfolio holdings of these companies. So we control for size. We control for size. Again, this is mutual funds here and 13F institutions. We control for the size, total net assets that's in the portfolio. We control for the size of the company. We control for the book to market of the company. We control for the most recent 12-month return of the company. And then we want to control for whether it's an SRI fund. We look at both the churn ratio and the turnover ratio are measures of how quickly the portfolio is being turned over. So the churn ratio is just using their holdings to measure this. The turnover ratio, mutual funds in the U.S. have to report their turnover ratio. So we find that, remember, the churn ratio, the higher the churn ratio, the turnover ratio, the faster they're turning over their portfolio. So the shorter term investors they are. And we find a negative relationship as expected between the fund level ESG score and these turnover ratios. We also control for this looking within the fund itself, whether we still find this relationship, and we do. And we also look, okay, is this being driven by just the SRI funds in our database? Are we just picking this up because of SRI funds? SRI funds are about 4% of the total assets under management in our database. So it's not the SRI funds that are driving this, but just in case we look at it and we still find that our results aren't changed when we separate out SRI funds. So the bottom line is that we find that mutual funds and other institutions that have longer horizons have portfolios with higher ESG scores. And it's not accounted for by the SRI funds. We also then switch to this firm level view. So what I've been showing you is looking at the portfolio of the different institutions. Now we're looking at individual firms. So when we look at individual firms, do we find that their owners tend to have longer horizons if they have a higher ESG score? And again, that's what we find when we look at this is the owners on average, their turnover ratio, churn ratio, or whether they're a certain kind of investor that has longer holdings. And so what we find, again, with this is that firms with higher ESG scores have shareholders with longer horizons, accounting for the other firm characteristics that could affect how people choose to invest in those companies. Okay, then our third test is what happens to a company in terms of ownership if they get included or excluded from the Footsy for Good index. And we do a number of different tests. I'm just showing one here, which is that we look at the companies that are included compared to very similar companies that could be included that aren't in the index. We also look at the companies that are excluded compared to similar companies in the index that weren't excluded. And so that's our long-term after index rebalanced and treated. And what we find is that firms newly included in the Footsy for Good index and firms newly excluded from the Footsy for Good index have significant changes in investor holdings compared to similar firms. So we do find, again, and it's affected by the investment horizon of the owners, whether they're long-term owners or not. Okay, so then we have another hypothesis, which is that there are researchers that have hypothesized that ESG CSR makes firm management less myopic. And so the question is, does this translate to the shareholders as well? Do shareholders that have more ESG firms, are they less myopic, or are they less myopic with their ESG firms? And so we're looking at, are they more patient? And so the implication is there should be difference in reactions to past stock returns or earnings shortfalls between high and low ESG firms within the same investor's portfolio. So restricting to one investor's portfolio, do we find that that investor is more patient with firms that have higher ESG scores than firms that have lower ESG scores? And in fact, we find So the first line shows that we have two things. One, do they sell or not? Do they sell the company or not after poor past returns? And so we should expect, the first line, we should expect a negative relationship between poor past returns and the probability of selling. And so we have just do they sell or not, or columns 1 and 2, and columns 3 and 4 is how much are they selling. And we find a relationship both with do they sell or not and how much are they selling. But when we look at the second line, this is taking into account the ESG score, and they are less likely to sell for firms that have poor returns but have higher ESG scores. So the bottom line is this: compared to other firms in their portfolio, investors are less likely to sell high ESG firms when they have poor returns. We also do the same thing with earnings shortfalls and find, again, that investors are less likely to sell high ESG firms when they have earnings shortfalls. So investors are more patient with high ESG firm management than they are with other firms that have less ESG. Okay, so the takeaways from this research are, one, there are real effects of firms improving their ESG profiles. If companies would like to attract longer-term investors, one way they could do so is by improving their ESG profile. And second, since having a long-term oriented shareholder base is often claimed to be desirable, companies may have strong incentives to do good in order to have the right investors. Okay, so that, again, going back to the firms with higher ESG profiles, according to the theories, they attract customers, lead to higher employee morale, attract shareholders, and are more likely to make longer-term decisions. The next question is, the theory says that firms with high ESG CSR profiles have decreased firm risk. And then, so the argument is that if you're analyzing a firm from the ESG perspective, it provides an opportunity to identify some risks that would not be identified in more traditional investment analysis. And these can be particularly important in emerging markets and with smaller firms. So if we think about the types of risks that could be affected by ESG, it may make companies less exposed to systematic risks, to just the market-wide risk. It may make companies less exposed to relative risk. Reputation and litigation seem more obvious, that if you have a higher ESG profile, you're less subject to reputation risk, you're less subject to litigation risk, you're less subject to supply chain risk, you're less subject to corruption risk, you're more up with what's going on with climate change, and you're doing things to be less subject to climate risk. You're less subject to estimation risk, which is just the risk of the unknown, the problem of trying to figure out what the risk is when there's a lot of uncertainty. You're less subject to tail risk or downside risk. You're less subject to political risk. Those are the arguments about ESG and risk. Now, these aren't mutually exclusive. And then tomorrow, Andres Holtner is going to give a talk on engagement and downside risk. So there'll be a specific focus on the downside risk tomorrow. I want to focus on climate risk for a few minutes now and talk about these are institutional investor views on climate risk and climate risk in their portfolio. This is based on a new paper that is with Philip Kruger, who's here, and Zach Sautner, and we literally finished writing it within the last couple of weeks. So this is the first time that we've presented any of the results. We had 439 institutional investors that we questioned on climate risk, and you can see they're from a wide variety of types of institutional investors. They, in terms of the investment structure of their portfolios, on average, they have about 40% share of their portfolio that is invested according to ESG principles. Now, this can vary from 0 to 100%. So on average, we find 40%. On average, we find about 47% of their portfolio is invested in equities, 43% in fixed income, and on average, about 38% are passively invested. They're from all over the world. I'm based in the U.S. Philip is based in Switzerland. Zach is based in Germany. So we were able to survey investors from many different places. And one of the things I thought I would show you is their climate change expectations. Now this we ask, by the end of the century, how much do you think the temperature is going to go up? And we divided it by the different regions. This first blue is all regions, and as you can see, there are a lot of investors who think it's going to be, the climate change is going to be more than the 2 degrees. I think after this summer, we might have even found it would be higher. But we found that there is, significant concern about climate change and what's going to happen in terms of temperature changes. We then ask the comparative importance of risk, giving them financial risk, operating risk, governance risk, social risk, climate risk, and other environmental risk. And as you can see, again, these are institutional investors, and we're asking about the risk of their portfolio. Financial risk is absolutely the most important. But they also find climate risk to be important. So, for example, 51% said financial risk was the most important, and a 1 meant it's the most important. And so you can see that these other risks, there's fewer that say it's the most important, but they still have some importance in terms of how they view these risks. We also ask in terms of climate risk, whether regulatory risk, physical risk, or technological risk, and we find that both regulatory risk and technological risk are the two things. Technological risk is also often called transition risk from climate change issues. We also ask for motivations to be concerned about climate risk, and this, in some sense, at least I wasn't expecting, maybe Philip was, I wasn't expecting it to be so spread, so varied in terms of the different motivations for being concerned about climate risk, and putting climate risk into their investment process. But we found the top motivation, and these were ones that they strongly agreed with. We found the top one was protects our reputation, which was 30%. And again, these are not mutually exclusive. They could choose more than one. 28% felt that it was a moral, ethical obligation. 27% felt it's a legal obligation. They have a fiduciary duty. 25% felt it was beneficial to investment returns. 24% reduces overall portfolio risk. 23% reflects their asset owners, their clients' preferences. And 21% felt like it reduces tail risk. And then there were also other motivations that we included, but these were the top ones. We also ask, how do you approach climate risk? How do you incorporate this risk management into your investment process? And the most common were analyzing the carbon footprint of the portfolio firms, analyzing stranded asset risk, just using general portfolio diversification, using ESG integration. But we also found that some reduced the carbon footprint of their portfolio firms, and some worked on reducing stranded asset risk. The one that was the least used in terms of risk management was divestment. We also looked at the number of risk management approaches they took. And we find that the mode is using at least 3 investment approaches, but you can see there's some that use many more than that. We looked at, in a lot of our tests, we looked cross-sectionally to try to explain the answers to this, what kind of investors are doing this. I'll just give you an example of the risk management. We find that more risk management approaches are taken by investors who view climate risk as being more material. These investors had medium or long-term investment horizons as compared to shorter-term investment horizons. These are investors who manage a higher proportion of their portfolio under ESG principles. Investors who've been incorporating climate risk into their investment decisions longer. Investors who are located in Europe, but not in the UK, not in the US. It was Europe that the ones that were doing this. And we found this was more often being done by mutual funds. We also ask about shareholder engagement on climate risk, and we found that there are a number of different ways they engage: holding discussions with management, proposing specific actions to management, voting against management, submitting shareholder proposals. So there are a number of different ways that these investors are engaging their portfolio companies on climate risk. And again, we found that the largest number were using 2 different ways, 2 different channels of engaging with their investors. We also found, in terms of engagement, again, it's those who view climate risk as more material, who believe climate risk will materialize sooner, with more assets under management, who manage a higher proportion of their portfolio under ESG principles, who have been incorporating climate risk in their investment decisions longer, and again, who are located in Europe. And in this case, we found it was more often asset managers and other types of institutions. Just quickly, in terms of looking at, we wanted to understand something more about stranded asset risk and how investors perceive stranded asset risk. And we found that, and so we used certain industry sectors to ask them about this. So this shows the percentage of respondents that believe that stranded asset risk is very high in the industry. And we found, not surprisingly, coal producers was the highest. Unconventional oil producers was next, then conventional oil producers, and so forth. But there's still, this is 25% or less of the investors that are worried about stranded asset risk in these in these different industries. We have so many more questions and interesting results that I unfortunately don't have enough time to show you. So these are just some of the ones. We ask about disclosure. We ask about pricing and mispricing, whether things were over or undervalued. So the takeaways, according to what I put up here, is that the investors believe climate risk to be important. and especially those that are related to regulation have even started to materialize. The most common motivations were to protect their reputations due to moral and legal considerations and because they believe climate risk can affect returns. So overall, investors consider climate risk as an important investment risk, and they've started to incorporate these risks into their investment processes. So thank you very much. There's a lot here. I just wanted to get it all out there.
All right. Start a little bit late, so you should have a couple more minutes. Do you want to take a couple of questions?
Sure.
Or do you want to postpone that to the panel later?
I can take questions now if there are any questions.
Hi, Henk Reinders from the Dutch Central Bank. A very interesting presentation, thank you. I was wondering, for the first part of your presentation, you hung together basically the E, S, and G issues. Do most of the observations that you find there also hold, or can you break down the insights that you have based on the environmental, governance, and social issues? Is that possible using the data? And can you spare a few words on that? Thank you.
Okay, so our last one where we did the survey on climate risk, Zach and I and Joe McCary have a separate paper where we just looked at corporate governance. So in some sense, we have that split. On the one where we're looking at the long-term investors, we have not yet divided it into environmental, social, and governance, and I think that's something we need to do. The one thing we did find is that it's driven more by the strengths than the problems, which is kind of an interesting result. But yes, you're right. We do need to look more. What has generally been found in the research is that governance is the driving force. And my way of thinking is, and this I guess is going to give away a little bit about what I was going to say during the panel, but I think one of the issues is that governance can have more immediate impact, whereas environmental and social issues are longer term, and so we may not see those results. I think it's a lot harder to capture what the returns are to environmental and social improving environmentally and socially, because there's such long-term effects.
Hi, Dennis Fritsch from Responsible Investor in London. Thanks for your talk. I just wanted to ask, in your research with long-term investment and ESG scores, did you look, which ESG scores did you use, so which providers? And did you look at different sources for these scores? Because there's been research that says that these scores don't necessarily correlate so well. Thanks.
Yeah, that's a really good question. We use the MSCI ESG scores, but we're going to try a different provider and see if our results turn out the same. That's a really good question. Okay, so one of the things we do is we're controlling within the portfolio. So looking at the same investor who's a long-term investor, are they less likely? So we do use fund fixed effects and control for the same investor. Okay.
Perfect. Maybe one last question and then we'll move on.
Oh, okay. So, but then, can I have one more after that? Okay.
It seemed from your results that there were more concern about ESG matters from European investors than from UK and US. Do you have any sort of story why this might be so?
No, but there are many more assets under management in Europe, according to socially responsible principles, than in the U.S., for example. So there's lots of evidence that there's more concern about this in Europe than in than other places, Asia, the U.S. But maybe you have an answer to this.
Hi, Adair Morris. I'm one of the organizers here. You may not want this last question, but the institutional preference for these factors, which is super interesting, this new research you're doing, do you have a sense on what % of those institutions are looking for, these exposures that you talk about based on a return model versus based on some sort of exposure in terms of career, media, institutional things that they care about, risk management that's not return, that's going after managing return, but not a return model per se?
So I think that we can nail this down a little bit better in our survey than we can in using just the empirical research with their holdings. And according to the survey, the motivation seems to be very mixed in terms of, is it the asset owner preferences, how much is return, and I think maybe we can dig a little deeper into our survey to try to figure that out.